All attendees are in listen-only mode.
Well, thank you everyone for joining us today. My name is Brian Coester. I'm the CEO of Coester Valuation Management Services. And today we have a webinar called 2015 Housing Looking to the Future. And on the webinar I have with us Ed Pinto. Say hello, Ed.
Hello, everybody.
And Ed was fortunate to join us on this. Just to kind of give you a little background on Ed, and you guys have really a diamond here in Ed taking the time to do this for everybody. But Ed is a resident fellow of the American Enterprise Institute. He's a co-director of AEI's International Center of Housing Risk, along with AEI's resident scholar Stephen Allner. Pinto is the creator and developer of the AEI Pinto Allner Mortgage Risk and Collateral Risk Indexes. Allner and Pinto are the creator of the Wealth Building Home Mortgage, a new approach to home financing designed to serve the twin goals of providing to a broad range of home buyers, including low-income, minority, and first-time home buyers, a more reliable, effective means of building wealth than currently available through existing policies, while maintaining the buying power similar to a 30-year loan. An executive vice president and chief credit officer of Fannie Mae until the 1980s. Pinto has done groundbreaking research on the role of federal housing policies in the 2008 mortgage and finance crisis. You guys have probably one of the best researchers and people that understand the housing market and housing policy alive today on the webinar with you guys. So feel blessed. The goal for today is to really talk about what to expect in 2015. A lot of Ed's work is done in housing risk, collateral risk, the value risk and risk levels of the market, as well as things associated with the GSEs, FHA, some legislative stuff, and that's kind of the goal, is to kind of give you a broad overview at a high level of what's going to happen over the next year, maybe even a little bit into the future beyond that. And that's it. So Ed, anything to add?
No, thank you for that very kind introduction, Brian. It's a pleasure to be on the call.
Yeah, appreciate it. We appreciate it. So if you want to go ahead and get started, this is going to be, and for anybody who has any questions, please feel free to message. We're going to do a Q&A session. The goal is we're going to let Ed talk for about 40 minutes and then do 20 minutes of Q&A. And he can, and if there's any questions that he can't ask, I'll try to ask, or we'll get you an answer later on. But first question is, what do you think of that's going to happen with GFE reform? Or can you give us a little background on the GFE reform?
Yeah, so the short answer is I don't think much is going to happen in the next session of Congress, which means 2015, 2016, in the next session of Congress. Why? It's been over 6 years since Fannie and Freddie went into conservatorship. There was a 15-year battle before that, ongoing battle about Fannie and Freddie's charters that finally led to charter changes in 2008, literally 6 weeks before they went into conservatorship. And then everything's been frozen pretty much since then as they entered conservatorship in September 2008. Congress, two houses, the House Financial Services Committee was the first out the box with the PATH Act, which would sunset Fannie and Freddie and severely restrict the government's role and eliminate any broad government guarantees for conventional loans. The Senate followed somewhat thereafter with the Johnson-Crapo bill, which was patterned heavily on the Corker-Warner bill, and that was passed out of the Senate Banking Committee. Neither bill reached the floor of their respective House, and both of those bills, the House bill dies. The Senate bill technically doesn't because the Senate is a continuing body, since there's never more than a third of the senators that get replaced each year. That said, both Johnson and Crapo are Johnson's retiring from the Senate, and therefore he's in his last days as a senator. And Crapo, who is the ranking Republican, will not be likely the chairman of the Senate Banking Committee when the Republicans take over. It will most likely be Richard Shelby, who was chairman of the Banking Committee the last time the Republicans had a majority. You can tell from the bill name that Shelby's name wasn't on it, and he voted against it. So it's unlikely that he's going to start with the Johnson-Crapo bill, and there's been a big shift, as you know, in the Senate. And, of course, you still have, as chairman of the House Financial Services Committee, the Representative Hensarling. So I think it's unlikely that, given all of this, and given the fact that Dodd-Frank was passed, 4 or 5 years now, I think it was about 4 years ago, and has been one of the least amended acts of its size in a 4-year period that we've had. Normally there's a lot of technical corrections that are made to statutes, and this one has had very, very few. That's not to say there isn't a pent-up demand to make amendments, both technical and otherwise, but because of the split in the House and the Senate, that hasn't taken place. Given the shift that's going on in the Senate, it's expected that a lot of the work of the committees in the next session will be focused on Dodd-Frank, and as many of you may know, Dodd-Frank was virtually silent regarding the GSEs. So that means the GSE reform may also, beyond the reasons I mentioned, take a second seat to reform of Dodd-Frank. And lastly, it's difficult to get legislation developed in a session, particularly if the Senate has to somewhat go back to first principles. That's usually a process that takes 4 to 6 years, and therefore it may just not be time. So with that, I think the chance of something happening in this next session, 2015-16, is quite low. That's not to say that something may not happen on FHA, which in the Senate there were 2 bills dealing with, one with GSEs and one with FHA. In the House it was in 1 bill, the PATH Act, and so there could be an opportunity to separate that out and move forward on FHA, but that's a different story.
Do you think that the election, and this will be at the point in the election at all, when it comes to 2017?
I doubt it. It wasn't a big point in the last election. It's interesting. My colleague Peter Wallison was at an event with Mitch McConnell, who's the designated, or I guess the majority leader-elect of the Senate, and he was speaking here at AEI a week or so ago, and Peter asked, did the issue of housing finance reform ever come up on the election trail? You know, he just got reelected in Kentucky, and the answer was no.
Yeah.
Nobody ever asked any questions about it. And then he was asked about Johnson-Crapo, and that never really made it onto the radar screen. It's a big issue in the housing world, but it's not necessarily a big issue on the national plane.
Got it. So just your prediction is everything's going to kind of remain slow and steady for the foreseeable future when it comes to the GSEs, for the most part. 2006.
For the most part, I think the one thing that we're seeing, the change from Ed DeMarco as acting director of FHFA, the regulator and conservator of Fannie and Freddie, to Director Watt, formerly of the House of Representatives and the House Financial Services Committee. He's definitely, Director Watt is definitely taking a very different direction than the acting director DeMarco. Let me mention just 3. One is that he's publicly stated that he doesn't view his job as winding down Fannie and Freddie. he views it as just preserving them or conserving them, and whereas Ed DeMarco viewed his charge more as winding them down and creating room for the private sector to somehow take the place of Fannie and grow into that vacuum. Secondly, he is much more aggressive, I think. He will be much more aggressive on affordable housing, and we'll get to this with the 97% mortgage, but much more aggressive in more liberalized underwriting than Ed DeMarco was. And third, he's likely to be much more amenable to cross-subsidies, and this comes back to the 97% mortgage and some other things, much more amenable to cross-subsidies by the GSEs subsidizing high-risk mortgages with earnings from lower-risk mortgages from a credit perspective than Ed DeMarco was during his tenure as acting director.
Now, we're going to go into that, I know, in depth when we talk about some of the housing risk and some of the research you've done when it comes to the risk level in the market. But what do you think a lender should expect from changes in 2015? And what I say from changes is, and let me frame this question a little bit, is if you look at 2013, you say was the year of all the regulations, where it's one after another, where they became enforced, where they came into action. Then you say 2014, and obviously there's some gray areas in there, but 2014 was, let's say, the year of enforcement, where the CFPB is hammered down. What do you think 2015 will be?
I would say two things. One is I think the CFPB has a very aggressive regulatory agenda. They just published their agenda for 2015. I suggest everyone take a look at that if you haven't seen it. It includes things like AVMs, automated valuations. It includes regulation of AMCs, appraisal management companies. It continues the regulations on servicing and foreclosures. They just came out with a new thing on that. They're going to be very aggressive, continue to be very aggressive. They have more money than the Fed, literally. I mean, they have more money than any government agency. They've been given basically carte blanche, and they're hiring up at huge levels, and that's continuing as we speak. And so their regulatory process, I think a lot of lenders on the phone could probably talk about this. I mean, when they come in with 10, 12, 15 people, even on a small institution, and move in for weeks and weeks at a time. So that's going to continue. That's now I think you're going to see, as I mentioned earlier, some action in Congress to try to rein in some of the unfettered power that the CFPB has. It's unique in the annals of government agencies in the United States, and so I think that's going to take up a fair amount of time, as I mentioned earlier. The other thing I think you're going to see, and again it comes back to this 97% mortgage and some of the stuff going on at FHA, you're going to see now that they've got some agreements out on buyback provisions. Some lenders are still going to be very reluctant, and I would say, fool me once, shame on me, shame on you, fool me twice, shame on me. If lenders believe that they're not going to be pursued for these bad loans if they occur and they blow up down the road because the government says make a lot of risky loans, the government will do the same thing they did this time, which is come after whoever, the private sector party that they want to go after. The government will never say it was their fault. It just isn't in the cards for them to do that. Having said that, there will be a huge amount of pressure in the 2015 to expand to the full extent of the credit box. I think that we're already seeing that the non-depository institutions have gained a substantial market share over the last year or two, and I would expect that would continue. Those institutions are likely to be more amenable to the pleadings of these government regulators to believe them that when they say, oh, this time is different. I think it's going to be difficult for the likes of, the large banks to agree to that, and so I think their share, as it's been dropping in most instances, their share may continue to drop or stay at a relative to where it had been, relatively low level. So I think that's the thing to watch. You mentioned, Brian, the work that the center does. We've been tracking the overall market. We've been looking at it in terms of risk. We've been looking at it by agency. We've been looking at it by state. We've been looking at it by some other characterizations. We are going to start in 2015 looking at it by lender channel, meaning type of lender, large bank, large non-bank, non-large bank, non-large, non-bank, credit unions as 5 categories. And then we're going to start looking at both the share that those are having and the trends on share and what the risk levels are, and then identify what's creating those, if there's risk disparities, what's creating those. So we're going to be shining a pretty strong light to bring some transparency to that, and so we think that could help illuminate. And we also then look at the statements that, oh, don't worry, there's going to be compensating factors, and we have generally found, particularly with respect to FHA, that those compensating factors are not present when they go out the risk curve. Less so in the case of Fannie and Freddie. There are some compensating factors, but still not to the full extent. One of the arguments that, again, we'll get to in the 97% is not to worry, they're going to be compensating factors.
Yeah, and so kind of to sum up what you think, there may be, and if I was a lender, there may be some offerings in Fannie Mae's reps and warrants that may say, hey, you can get a little more risky when it comes to a loan, but that doesn't mean that you're not. And so if I'm a lender, I can say, oh, I'm off the hook, but that doesn't mean you're off the hook from any regulatory agencies coming in and saying, hey, you're not, just because you're following the guidelines doesn't mean you're out of risk from their perspective.
Absolutely. It doesn't mean that the Fannie and Freddie won't come back to bite you 5 or 6 years from now. I mean, lenders that have been in the business for quite some time may recall that Freddie Mac had a pretty firm guidance that once a loan, had performed for 3 years, you were pretty much off the hook. And Fannie didn't. And Fannie was pursuing lots of buybacks of loans over 3 years, after 3 years, and Freddie wasn't. And then Freddie's regulator pushed them to reverse that, even though it had been a relatively long-standing provision. So again, these promises, you have to understand where they're coming from. They're coming from agencies that wield tremendous power.
And furthermore, I mean, if you were just going to state something that's more recent, with what kind of, let's say, if you get, the collateral underwriter when it comes to the appraisals, I know there's a lot of talk about, if you get a DU approval and a CU approval, you have, full reps and warrants, and what you're saying is that might not be the case.
Again, if push comes to shove, these agencies have shown in the past, and the regulators have shown in the past, they really don't care what the paperwork said. They're going to be looking for somebody to take the fall.
Got it.
Now, they tend to be larger institutions, deeper pockets, but because that's exactly what they did in this last go-round. They tended to go after the big guys and get multi-billion-dollar settlements. But I think the bigger issue is that a segment of the market, and this happens all the time in mortgage lending, there will be a segment of the market that is just much more willing to move out the risk curve. You see it in the FHA lending. There are certain lenders today that are much more willing to move to the full extent of FHA's credit box than most lenders, and you'll, I think, see it in Fannie Mae and Freddie Mac. Again, Fannie Mae on the 97% loan is theoretically or in their guideline goes down to a 620 FICO. That's a very low FICO for a 30-year 97% loan with up 43 or even higher debt ratio.
Got it. Okay, and then this our next question. We kind of talked about this a little bit, but what do you expect from the CFPB? I mean, we've kind of covered this a little bit briefly in our previous question.
Yeah, I think take a look at their regulatory plan for 2015. See how that intersects with what whoever's on the call, what your particular interests are. Obviously, if you're an AMC, you're going to be very interested in their AMC regulation. If you have something to do with AVMs, likewise. If you're a servicer, they're going to get even deeper into the servicing regulations and interpreting those as they just did in terms of 2 bites at the apple. If you start a foreclosure, you stop a foreclosure, and then you get another bite at the apple on a modification, etc. And so those kinds of things they're going to be continuing to fine-tune. And then, of course, they're going to be doing a lot in the supervisory area, including there's a lot of interest in moving out to the non-depositories and supervising those. And, of course, FHFA is also getting into that at the same time. So there's just going to be a lot more oversight and a lot more regulation coming out of CFPB.
Got it. Okay. You want to go to the next question, and so a lot of your blog. I mean, and guys, if you haven't checked out, Ed's research and publications, you definitely want to go to housingrisk.org and check it out. But a lot of your research centers around FHA with your, FHA risk index and all the other things that you have. So what's going on with FHA?
So FHA, has been around. It's the 80th anniversary. I've actually got a conference that putting on here at AEI on Friday. FHA, its first 5 years, 1934 to 1938, that really talk about the concepts FHA pioneered, and then, unfortunately, after about 20 or 25 years, were largely abandoned, with the exception of the VA kept many of them. Things like residual income started with FHA back in 1935. And so FHA had a very strong underwriting, sustainable underwriting. It got away from that. I've calculated that 1 in 8 FHA borrowers went to claim over the period 1977 to 2000. I think it was 12. It was 3-point-something million borrowers over that 30-something year period. That is not a record that, if I were at FHA, I'd be proud of, yet FHA seems to be proud of that record. And so they clearly had problems with this latest downturn. They've been financially challenged for many years. They still are below their capital requirements. They had to raise their premiums substantially. I don't believe that there's going to be a successful effort to reduce their premiums at least for 2 years. The reason I say that is FHA's own actuarial projections indicate that they won't be at the 2% level for at least 2 more years, and even at that, it's right at the 2% level, 2.00. What a coincidence. And number one, and number two, there's some language in their annual actuarial report that talks about the need to build up a cushion during the good times to protect against the bad times, and that cushion is more like 4%. They then have some language to talk about how many years they have to do that. But FHA, we've been, doesn't feel like it, but we've had an expansion that's been going on since June of 2009, and so it's actually a pretty long-lived expansion. And if that were to turn into a recession anytime in the next year or two, all of FHA's numbers you could throw out the window. So FHA still has financial challenges. As I said, I don't think their premiums are going to change much. They're going to, try to do this hawk thing and some other stuff around the edges, but I don't think you're going to see a big change in the premium structure in the next 12 to 24 months. They will be pushing for expansion deeper into the credit box that they allow, which they go down to 580 and below, but down to 580, and they're be pushing lenders to expand through the changes that they're making in their they don't have the same kind of rep and warrant process, but in their underwriting review process for originators. I think the reverse mortgages it continues to bleed money, and they've got a very wide disparity in their actuarial study between what they consider their normal outcome, their 50% point, and then as you move away from that 50% point, the amount of money they lose gets very large for a program that's actually quite small. And so that program is still very, very much not out of the woods. Let's see. They just came out with a new, the new loan limits. They didn't change much. They went up, here and there, but in general, they haven't changed much. Again, as I said, there may be an opportunity in 2015-16 for Congress to do something regarding FHA. The louder the noise becomes for FHA to change their premiums, reduce them, meaning reduce their premiums, that may increase the likelihood that Congress moves in order to stop that. Because if the one thing that was clear in both bills that passed that were the Senate bill and the House bill was that the capital requirement was inadequate. And so if FHA makes a lot of noises about reducing their premiums and they're still below the 2%, I think that's somewhat like waving a red flag in front of a bull. So that's my view on FHA.
Now, one of the interesting things that has happened is Fannie Mae has recently come out with a new, 97% loan-to-value product, very similar to what FHA had with the 3% down. And some of that, and in my personal view, which doesn't mean much, but my personal view is that it was kind of a shift to move, let's say some of that volume to another GSE. What's your take on the new Fannie Mae program?
Well, I think it's a Fannie Mae Freddie Mac program, and it's not really new. Let's just go to this slide, which shows the percentage of FHA-insured loans greater than or equal to 97% going back to 1981, and the percentage at Fannie Mae going back also to 1981. Fannie Mae first offered 97% loans in 1994, and it was a result of the affordable housing goal mandates of the so-called 1992 Safety and Soundness Act. And you see it started out very slowly and grew to be 40% of Fannie's production, their home purchase production by 2007. And so these things never really start out as huge programs. They start out small and then grow. The other thing I would point out is no one ever starts one of these programs saying, we're going to make bad loans. They always protest that this time is different. This time they're going to do it right. And the problem, of course, is, as I said, no one ever starts one of these programs saying, oh, we're just going to do really bad loans and have a lot of foreclosures. So I think this is the tip of the eye, the nose of the camel in the tent, just like it was back in 1993, 1994. I think they're starting out at a point that they're already doing a very large percentage of 5% down loans, much more than they were doing back in 1993, 94. And they're stating that they're willing to do these loans, as I mentioned, down to a 620 FICO. In the case of Fannie, it's a higher FICO in the case of Freddie, and they really haven't had any the public compensating factors noted, and everything's in the black box of the DU. And as we know, historically, DU as they decide they want to expand the volume, the DU underwriting guidelines that are not transparent to everyone end up getting loosened inside the black box, and in order to juice up the volume. So the problem I have with this program is it's based on a 30-year fixed rate amortization, and that is not a sustainable way of putting people into homes. And as we'll see, there's a tremendous amount of volatility in house prices, and therefore it makes it very difficult to reliably build wealth when you're paying the loan down as slowly as you do with a 30-year amortization, starting with virtually no down payment to begin with, 3%.
Got it.
But they're going to be pushing it. The regulators behind this, Director Watt. It's being dovetailed with the efforts by FHA to move lenders down to the bottom of the FHA credit box, which, as I said, went down to 580. So this is an orchestrated effort. You may see likely we'll see some changes in the LLPAs and perhaps even the G fees that would get back to that point I mentioned earlier, the cross subsidies. I think you're much more likely to see cross subsidies flowing from 80% LTV loans and 75% LTV loans to subsidize these 97% LTV loans to bring the cost down. Got it.
Now, the slide that you showed when it comes to the Fannie Mae program, that's all based on your research, right?
This one? Yes.
Okay, so this, and for everyone on, Ed's a very, very highly sought after researcher in the mortgage industry. So a lot of these things going off or talking about are directly, from him. And just want to mention, you guys, we're starting to get some questions. If you have any questions for Ed, we have about 10 more minutes before we start going into questions, and just feel free to send them over. Now, what's going on with first-time homebuyers?
Okay, so you hear a lot of discussion about first-time homebuyers, and are they? Is it because of credit conditions, or is it because of the economy, or is it because house prices have gone up quickly over the last 18 months? I'm of the opinion that the credit box today is actually historically pretty loose. I'll talk about that in a minute a little bit more. I tend to think it's much more due to three things. What has been a pretty weak recovery since 2009. Even today we're up in the mid 200,000s on job growth, but in order to actually expand the job pool beyond what the growth of the population is, and bring some of these people that have been discouraged out of the shadows, you actually need over 300,000 jobs per month, and we haven't really been at that in any consistent way for quite a while. So I think it's a combination of a slow economic recovery. It's picking up steam some, but still pretty slow. Secondly, you've had a stagnation on a real dollar basis of wages. So house prices have been going up, but wages have been stagnating. And the third thing, of course, is house prices have been going up faster than even inflation. So if wages are stagnant relative to inflation and house prices are going up faster than inflation, that's going to push against the ability to buy a home. And then you still have a lot of concern about, is now a good time to buy given what happened. What did I do? Okay. Okay, so one of the things I did with my research was to track credit conditions 1990 to the present. getting this data together is not easy. It's very hard to get at these kinds of things, but I've got a lot of information in my archives. I've been tracking this. I was one of the individuals that helped put together back in 1989 the loan performance data set that's now CoreLogic, and so I've been tracking this for a very long time. And so when you look at credit conditions today, DTIs are quite a bit higher today than they were in 1990 and 92. They're about the same as they were in 2000, 2003, and they're lower, of course, than they were in 2005 to 2007 during the complete excess in underwriting or abandonment of underwriting standards that occurred towards the end. But they're substantially above what they were in 1990-92. FICO scores today are not much different than they were in 1990-92. They are, of course, higher than they were in the aught years. LTVs, FICO scores below 640 is the one thing that is down from where they were in 1990, but the FICO, and they're down, of course, from 2000, 2003. CLTVs are substantially higher than they were in 1990-92, and the aught years less substantial but still higher. And the CLTVs above equal to or above 97 are way above where they were in 1990-92 and 2000, 2003, only slightly below, somewhat below where they were in 5.7. And again, that's the push is actually to return that to the level that it was in 05-07. So DTIs are higher, FICO scores are lower, CLTVs are higher than the 90s and the early aught years. So I read that to mean, on balance, we do not have tight credit. We've got fairly expansive credit, particularly first-time home buyers, given the down payment, but FICO scores are somewhat higher. Low doc, no doc, they were nil back in the early 90s. They were pretty low back in 2000, 2003. They reached a high point, 25% in 05-07, and they're nil again today. 30-year fixed rate loans, interest rate, that's one of the things in terms of affordability. Interest rates well under half what it was in 1990-92. So again, you look at the credit side of this, and it's generally looser credit, but interest rates are 6% lower, which tells you that we're going to be in a world of hurt if the interest rate repression that's been going on by the Fed for the last 6.5 years, when they finish with that and interest rates return to some level of normalcy, then we're going to see an impact on affordability. And then the question is, do house prices drop, or does the federal government respond by pushing even looser credit? And my money would be on looser credit, because that's always the response the government tends to have. First-time home buyers are actually higher today than they were in the early 90s. And this perfect credit, you hear lots talked about, oh, you need to have perfect credit in order to get a loan today. It just isn't true. About 60% have perfect credit, but that's because about half of all the people that have a credit score in the United States have perfect credit. You'd expect that people who are getting a $200,000 mortgage would have better credit than the norm. And we show that our National Mortgage Risk Index is higher than it was, higher today than it was in 1990. We then have our housingrisk.org that Brian mentioned, that we publish a few things I'll go through quickly. In terms of this chart, which I call the flame stitch chart, is something that we put together based on Zillow data. We're getting the updated data from Zillow, but we haven't gotten it. We're about 3/4 behind. We're waiting for it. But what it says is that if you go back to 1980 to the early to mid-1990s, it was normal to have about 20% of all markets correcting at any one point in time on average. So if you just follow that red line from the left to the middle of this chart, you'll see it averages around 20. it doesn't hit 0, and it doesn't get above, it gets slightly above 40 in one case, but it's basically is around 20%. Then something very unusual happens in late 1994. The volatility at this negative end, house prices dropping in an MSA, pretty much vanishes, and we have a period that goes on from late 94 through early 06, which is an extraordinarily long period where only about 5%, or in this case, since there are 51 cities, 2 to 3 cities a year, or MSAs a year, where the house prices have dropped year over year. That, think of it as a pressure cooker, where the way a pressure cooker works is you screw down the top to allow the pressure to build. Well, that's what happened in the housing market from 94 to 2006, is the pressure was building up because underwriting kept getting looser and looser, and there wasn't any need for these corrections because everything kept being driven by looser underwriting and rising house prices. When the music stopped, of course, you see what's on the right side here. We had an unprecedented level of correction where we had 50 out of 51 cities on the far right correct back in 2010 or 2011, which was unprecedented. We've now seen a few quarters where it's dropped again below 20%. That's why I want to get this updated. I think it's still pretty much in this level. It might be at the 5% level, but it's still pretty close. We think watching this, we need to get back to a time where 20% of the markets are correcting. There's nothing wrong with corrections, just like the stock market. The index we put out, we calibrate against some data we have from 1935 to 1955 with FHA. For 1990, I've already mentioned, and then for 2007. Today, we've got an index level that is about 11%, and FHA is at 24%. That's way above where FHA was back in the 1935 to 1955. Also way above where they were in 1990, but below where they are in 2007. The VA has a much lower index level than FHA. Part of that is due to just the metrics of the loans themselves, but it's mostly due to the fact that FHA loans just perform, all of the things being equal, a lot better, and that's because of some of those underwriting things that FHA didn't abandon. This is the index itself. It shows there hasn't been much change in the composite over the last, we've been doing the index for just about 2 years. The Fannie Freddie index has been going up slightly. The FHA RHS index has also been going up slightly, but because the market shares have changed slightly, the composite index is pretty flat. Then we look at California to bring it down to a particular market. California is the most volatile housing market historically in the United States. It's been that way for many, many years, many decades, going back to the late 70s. And so we think it's really a barometer of what's going on. And then within California, Riverside, San Bernardino is probably the most volatile. And so what we've done is we've taken some housing cycle risk indicators. The first one is from Fitch, from John Burns. The second one is also from John Burns. The third one, Sustainable Home Prices, from Fitch. Bubble Watch is from Trulia. And then the up-down ratios are from Weiss Residential. And so they all pretty much show the same thing. The intrinsic value in California is elevated. The market values are elevated above intrinsic or sustainable prices, and they're most elevated in a place like Riverside, San Bernardino, which also tends to be low income and high minority. With that, turn it to questions.
Yeah, and we do have a good amount of questions. First one is, do you think there will be another bubble, and then when?
I think there will be another bubble. It's hard to say when. It's going to depend on the reaction that is taken when the Fed inevitably, but when is always a question, raises interest rates. The problem we have in this country is that we've got two gas pedals that we use to modulate what's going on in the housing market. We have the leverage gas pedal, which are the GSE regulator underwriting requirements, and we're seeing that gas pedal getting pushed today by FHFA, Fannie and Freddie in the release of the 97% loan. So that's one pedal to juice the market. The Fed has its own pedal, which operates independently, and they've been doing quantitative easing for the last 5 or 6 years, or well, interest rate suppression. I mean, they've kept interest rates in the zero boundary for 6 years, and they've had quantitative easing for the last 3 years, which now leaves them as the largest investors in agency securities in the world. And so what the worst that could happen is for the Fed to start doing something with interest rates, which then gets a reaction from the regulatory GSE side in terms of loosening underwriting standards, and then if that doesn't happen quickly enough, then the Fed reverses course and then tries to juice the market with lower interest rates. That could really create a bubble situation, because what happens is these stimuli that get put on, either in the form of leverage or lower interest rates, end up getting capitalized into house values and then create this deviation from intrinsic value. Again, if incomes continue to stagnate, that's another recipe for house prices going up faster, and that's what leads to bubbles.
And so it could happen. All the mechanics are there, but
And so that's why we track all this stuff on that last slide. That is our bubble watch.
Yeah.
So you can see that in California, we've got some markets that are 10, 15% overvalued. Nationally, you see this national average down here. It's pretty much at a flat or sustainable level. So that's what we're watching. We use this particular chart in conjunction with the overall risk level, which is a chart we normally show right before this one. It's not here. And we use those two charts to really measure. So today, do we have a bubble today? No. Are there some bubbly places? Yes. Are the bubbly places ready to pop? No. But do they bear watching? Yes. Where are they? They tend to be in parts of California and some other areas of the country, but California is always a good place to watch.
And here's another question: Do you think the market can survive? Since you talk about GSE conservatorship and getting rid of the GSEs, do you think the market can survive without the GSEs?
I do. My colleagues Peter Wallison, Alex Pollock, and I wrote a paper on this back in 2011. Housing finance reform, how to take the federal government out of housing finance. In my opinion, the federal government has been had a destabilizing impact on the market. It's really done some crazy things with house prices and leverage. But secondly, there have been two massive taxpayer bailouts, both tied to the 30-year fixed rate loan and the GSEs in the second case also. The first was the thrift bailout, which reached its crescendo in 1991 with, I think, $150 or $60 billion bailout. And then, of course, we had the GSE bailout. I happen to think that the problem is that we have made the 30-year fixed rate loan the standard, and it's not the right instrument for large sections of the population, particularly if the goal, which it has been for 50 years, has been to drive up the home ownership rate. Well, the problem is we haven't moved the needle on the home ownership rate. It was 62% in 1960. It's 62.4% today if you subtract out the people who are in foreclosure or seriously delinquent. So we're at the same spot. What have we done in the process? We have reduced leverage tremendously. We've pushed loan terms out tremendously. We've pushed debt to incomes up tremendously. We've driven house prices up, but we haven't changed the fundamental factor of home ownership. It's still around 62%. Therefore, the policies we've been following aren't actually accomplishing what the politicians say they're accomplishing. And so I think it's time to look at this differently. I think the solution is to come up with a shorter-term loan that's fully amortizing. My colleague Steve Olner and I have developed a wealth-building home loan that we put out on the public green back in September. It's been getting a very strong response. There are two CRA versions outstanding, one by Bank of America, one by Citibank. We've got one private sector version going with Andrews Bank up in Lewiston, Maine. We've got other lending institutions that will be rolling out their versions of this on a market versions in the first quarter. We've got mortgage insurers looking at this, and not quite a number of them. We've got investors looking at it. We think it's potentially a paradigm shift because it will allow the private sector to actually fund the mortgages much more, with much less risk, both credit and interest rate, and at the same time assure that home buyers are actually on not only a sustainable path to home ownership, but a reliable path to wealth building, because the wealth building feature has also been forgotten. You may all remember 5-6 weeks ago there was a lot in the press about the fact that net worth stratified by income for low and middle income households has been on a downward path. It's been on a downward path for a long time, and so the policies that have in place just haven't addressed it. We need to change those.
Gotcha. Now, when it comes to, I know a lot of your research is done around FHA. When it comes to FHA property standards regarding appraisals, I know a lot of buyers and homeowners have issues qualifying for an FHA loan because their property doesn't meet the minimum requirements. Do you see those changing at all? It's one of the questions.
Well, I think they should change, but I think maybe they should change it differently than perhaps your question surmised. I happen to espouse not everything that the VA does, because they could update a few things, but in general, if I were to choose between what the VA does and what FHA does, I'd choose the VA any day of the week.
Gotcha.
Because I think the VA goes a far sight better at protecting both the consumer and the lender in their policies. I would just observe that, as I understand, looking at the VA guidelines and talking to the VA personnel, that an appraiser, they specifically say that in their the VA guidelines, and if you are a professional real estate, you are a real estate professional, and you are a trained observer. So those are your two qualifications. You're a real estate professional and you're a trained observer. We expect you, when you go into a house, to be both. And if you see a water heater, and I think this is the example they use, if you see a water heater that looks to be, beyond its useful life or at the edge of its useful life, as evidenced by rust around the bottom or water rust marks on the floor, then you're to note that on your report. And it's up to the lender, who has some skin in the game because it's not 100% coverage, it's up to the lender to make sure that water heater likely will be replaced. They specifically say you're not to just recommend that they get an inspector. That is something that I think is missing from FHA along with other things, but that's one thing. FHA used to go through a very similar process. As I said, just about everything the VA does started with the FHA process back in the 30s, 40s, and 50s. So I think the FHA is doing a disservice to the consumer in a lot of ways, the way they underwrite their loans and the way they manage the appraisals. I think the VA does a much better job, and I think that is in large measure once you adjust for income and geography and other loan characteristics, why the VA loans perform. They have about a 40% lower default rate than FHA loans.
Gotcha, gotcha. And then final questions before we got to wrap up. Thank you guys so much for giving great feedback. What do you think about non-QM loans? Do you have any comments on those?
Well, it's interesting in moving forward with the wealth building home loan. We're getting a couple of the lenders saying, boy, you know, we're really comfortable with this underwriting. It includes residual income as a part of it. We're really comfortable with this underwriting. We're comfortable with the 15-year term. We'd be willing to make these loans and hold them on our balance sheet as QMs if we have to. You know, they're going to try to do them as QM, but there are some what I call regulatory underbrush that would be nice to get rid of. That really, you know, was when the CFPB put together their rules, they weren't thinking about 15-year amortizations. That much we can be assured of. They were thinking of 30 years. So a lot of these regulations are designed for 30-year amortizing loans, and that doesn't fit all that well necessarily from a risk perspective, risk exposure perspective, to a 15-year loan. So that's the response we're getting on the wealth building home loan. I hear, you know, just reading in the various mortgage media, you know, that there are lenders that are, you know, tiptoeing in. Of course, they've been doing that for some time at the high end, but I hear that's going on more in the middle end, but it's very hard to get data on that. And I just did get this morning a piece of data that 30% by dollars, and we're trying to now calculate by units, by loan units, but 30% by dollars of the production, the home purchase loan production in the first 9 months of 2014 was private. Meaning non-agency. And we've been assuming 20% of the units or loan count was non-agency. We think when we adjust for the different loan sizes for private versus FHA, VA, agents, GSE, we'll get to a number that's not too much different than 20%. So that percentage has been growing over the last 3 or 4 years. I do think that Ed DeMarco was somewhat successful in implementing some policy changes that were promoted that. I think we, you know, at one point we were at about 92% agency, and now it looks like, on a loan count basis, now it looks like we might be at 78 or 80%. You know, that's been in a couple of 3 years. It's definitely progress, and the trend seems to be moving in that direction.
Gotcha. And then kind of in closing, can you talk a little bit about, you know, housing risk, your research, the housingrisk.org, your research, and maybe your wealth building home mortgage? Just, you know, a lot of the listeners are lenders, and maybe, you know, how to get involved and stuff like that. We got a couple minutes.
Sure. So what we looked at when we look back over the disaster that occurred in the aught years and the reaction in the early last few years, what we concluded was that the problem was that there was nobody was tracking risk in an objective and transparent manner. By that I mean people were tracking house prices, but house prices are not a leading indicator. People were tracking delinquencies, but delinquency rates were their lowest, according to the MBA, 1 quarter before house prices started collapsing. It's not, these are not leading indicators. And so we concluded that what we needed was 2 things. We needed to track risk in an objective way, just like you would decide that a building on the Atlantic Ocean down in Miami Beach could withstand a 140-mile-an-hour hurricane. It doesn't mean that you actually had a 140-mile-an-hour hurricane. You just apply engineering standards that tell you it could withstand that. Well, we decided we needed to do the same thing for loans. What can they withstand? And it makes sense that you'd want them to measure against withstanding the worst that we had, which was basically for the GSEs, 2007 was the worst year. And so we created a stress test using the loan performance data that the GSEs released about 3 years ago. We've updated it a couple times to create what we call a periodic table of risk based on 320 risk buckets for plain vanilla 30-year loans, and then we have other adjustment factors that adjust for loan term and whether it's an ARM or whatever, but we have this plain vanilla 30-year fixed rate, fully amortizing, fully documented, owner-occupied loan. And that enables us to take loan level data that we get every month. We're in the process of running that data for the November release, which we just got that last bit of data yesterday, and so we're in the process of running that. And then every month we have a conference, a briefing by phone. It's usually the fourth Monday of the month, but this year it'll be on the 22nd of December because of the Christmas holiday. You can go to housingrisk.org and you'll find the invitation. Eventually, we send out the invitation next Monday and post it. If you want to get an invitation regularly, just send me an email at edward.pinto@aei.org, edward.pinto@aei.org. So by having this loan level data, which for the agencies covers, as I said, roughly 80% by count of all of the loans that are being originated today every month, we're actually measuring things. We've got a yardstick and we've got change, and we can measure that very objectively and transparently. We've been informed by this research and what we found that says the second step is you need to figure out where you are in the stress spectrum, which is going back to the chart that I mentioned earlier, which is our first endeavor to start measuring the stress level and where we are, and we're focusing on California as a proxy for that. And we will continue to, every month or two, we improve on this. We're continuing to work on that. We've got some of our own databases that we're creating with millions and millions of properties and information on those properties to create collateral risk indices and things of that nature. But this is our first shot. And then lastly, we've taken what we've learned here and then developed the wealth building home loan, as I mentioned, which basically takes a 15-year loan, fully amortizing, and says, how can we make that so the buying power is closer to what you get with a 30-year loan than what otherwise would be. And so you start out with the 15-year loan having a lower interest rate because it has a shorter duration, etc. The G fees are lower. So even if you don't have mortgage insurance, you're at a lower interest rate for those two reasons. Then we've gone to the mortgage insurers and asked them to provide mortgage insurance quotes specifically for a wealth-building home loan that has the underwriting that I've mentioned, residual income, some of the other things. That's, we think, a big contributor to somewhat leveling this playing field. Third, because so much of the principal and interest is going to principal, about 78% in the first 3 years goes to principal on a wealth-building home loan versus 32% going to principal on a 30-year loan, and therefore you can have a slightly higher debt ratio, housing debt ratio, safely, because this is really forced savings. And then lastly, we repurpose some of the down payment for a buy-down. It can be a permanent buy-down or it can be a step buy-down where it's in a place for 5 or 6 or 7 years. And so the bank up in Maine that has done this has done a step rate wealth-building home loan. The rate starts at 1 3/4% and is fixed for 7 years. They're able to get to 99 and change % of the buying power of an FHA loan. And we think that's pretty darn good to have a private market solution that can get to 99% of an FHA execution and do it in a way with 65% less risk and have this huge wealth building that goes on through this amortization that occurs, in the early years, eventually pays off the loan in 15 years. So those are the things we're working on. Anybody that's interested in that, again, can email me at edward.pinto@aei.org.
All right, Ed. Well, thank you so much. And this webinar has been I think, one of the highest retained webinars that we've had. And for people who are wondering, this will be available. This is recorded and will be available on our YouTube channel that we'll send out to everybody that attended. And if you have any questions, I highly recommend you guys subscribing to Ed's research at housingrisk.org. That they have a lot of good information. And thank you so much. Thank you, Ed.
Thank you, Brian. It was a pleasure, and thank you to your audience.
And,
those great questions.
And look forward to maybe we'll do one in 2015 and give an update on what really happened.
That'll be the test.
There you go. Have a good one, buddy. Thank you so much.
Thank you. Bye now.